I'm Ida Sadu, and I'm the proud managing director of a Different Booklist Cultural Center, the People's Residence. A Different Booklist Cultural Center, the People's Residence, is proud to be in collaboration with Schulich School of Business. We are going to now present an incredible module for all you excited people who are just anxious to get your teeth into business and in entrepreneurship. From the time we wake up in the morning, numbers determine and dictate all aspects of our life. And when we speak and think of business, we think of demand and supply. And somewhere between that equation, numbers are dancing. Numbers are telling us about possibilities. Numbers are informing us of what to do, where to go, and how to get there. And so it gives me absolute pleasure to introduce an incredible professor, someone who always says, let Excel be your friend. And that is none other than Professor Giri Kanagaretnam to speak with us and to share with us his thoughts and ideas and his thinking on finance and accounting.
Thank you, Aita. Thank you for that kind introduction. So my name is Giri Kanagaretnam. I'm a professor in accounting at Schulich School of Business, and I also teach this course, Management Accounting, for the MBAs. So I'm really excited today to talk to you about this topic of accounting and finance in the context of entrepreneurship. And in the short time I have today, my objective is to introduce some of the key accounting and finance concepts, examine some of the cost structures and operational risk factors, give you a tool to prepare an income statement, and some tools which you will need to present your business ideas and plans, some things like break-even points and projected cash flows. So those are the learning outcomes we are trying to achieve today. And we will go through a couple of concepts and a couple of examples to work through these, to get the understanding on some of these concepts. Again, in accounting and finance, we are interested in value drivers. So you have these great ideas and you want to implement those ideas. But then when you want to implement those ideas, what would drive the value of your enterprise? So will it be, so you know for sure that you have to be making profits, right? So because you are investing your time, investing some capital, either sweat capital and financial capital. So you are looking to make profits. So that's one of the key objectives you're going to have, and that is going to drive the value. The other key objective is going to be growth. Can you grow your enterprise, and how will you grow your enterprise? So those are a couple of things you are already keeping in your mind when you are thinking about ideas and selling your ideas and bringing your ideas to the market. So you're thinking about profitability and growth, and those are the underlying value drivers you're looking for. So when you're thinking about profitability, you're going to focus on what drives your revenues. And so you want to make sure that you are looking at a healthy amount of revenues. And then you are on the other side of the equation, what are your cost drivers? So your objective, of course, is to maximize your revenues and minimize your costs. So if you want to increase your profitability, a simple model is think about how can you increase your revenues while keeping your cost under control. And that's where we are going to talk about cost structures and what kind of risk those cost structures will present to you. Then moving on, we will look at budgeting, because whenever you have an idea, you want to present that idea in a business plan, you need to have some kind of forecast and some business model, financial model. So that is when your budgeted income statements will come into play, and side by side, you will also have your cash budgets or budgeted cash flow statements. And finally, we'll think about, okay, you have these great ideas. It seems it's going to be profitable and it has a lot of growth potential. Then how are you going to finance those that idea you have? And that's where you are thinking of writing your business plan, your marketing plan. You're going to incorporate your financial models, and then seek out financing from banks or from your friends or your family, from investors. So you will go looking for financing. So that's a couple of topics we will try to cover in this short period of time. Okay, so when you're thinking about accounting and finance, traditionally you will think about accounting as building financial statements. These are people who are pouring through books and who are interested in preparing their income statement, their balance sheets, and getting that audited by some external parties so that there is trust in those numbers, and then preparing these financial statements are again used to pay taxes to governments and your local municipalities and such. So what is the accounting we are trying to do today is more internally focused. How can you use these numbers to express your ideas in financial modeling and know how those numbers bring sometimes, or your business structures bring risk to your activities. When you think about finance, you all think about trading stocks and bonds, or now cryptos. So it's all about financial markets, and then comes all kinds of investments. I'm going to invest in stocks, bonds, some alternate investments. But again, in our context today, we are interested in finance about how can we get good ideas funded. So how do we get funding for good ideas is something we will be focusing on. So the focus today is not your traditional accounting and finance, but the accounting and finance in the context of new ventures and new entrepreneurs. So moving on to the next slide. So as I mentioned, so the accounting in our context is transforming your business ideas into financial forecast, demonstrating profitability, growth, and healthy cash flows. And so like now that you have great ideas, how do you implement those strategies and following up on those strategies? And when it comes to finance, how do you seek funding? Where do you seek funding? How do you convince people to invest in your new ideas and ventures? So those are our main objectives today. So an accounting and finance from a very different lens than what normally you would think about accounting and finance. So I'll start with some simple ideas next. Again, like as I mentioned before, when you want to create enterprise value, we want to think about profitability and growth. And then when it comes to profitability, it's revenues and cost. So how can you increase your revenues while keeping the cost? So you need to think about what are your revenue drivers, what are the revenues which are more recurring, and what are revenues transitory, which means that might change from one period to the other. And when it comes to cost, you are thinking about how much flexibility do you have. So if your orders dry up or your revenues dry up, will the cost remain? Or do you have flexibility in your cost so that you can avoid some of the cost and not being saddled with things which you can't avoid in the short term? And growth, of course, is how can you scale your ideas And on the revenue side, what are your main revenue drivers, and can you think about other sources of revenue? So if you're thinking about, say, running an airport now, or passenger traffic is like 90% less than in the good times. So can you now think about other, and then all the other ancillary service revenues have dried up, like restaurants and shopping plazas and all that. So can you think about other revenues in the forms of maybe now you have freight revenues, or even medical testing inside the airport? So can you think about the other revenue sources than your main revenue sources? So now to going into more micro level, I'm going to introduce the cost structures and the risk those type of cost structures can bring about to your business. So we generally have overall two different types of cost. One is a variable cost, which is a cost which changes in direct proportion to changes in the units you produce or consume. A good example is cost for your food. Like, if you eat one burger, it costs you like $5. If you eat two burgers for a meal, it's going to cost you $10. If you eat three burgers, it's going to cost you $15. So your cost will change in a direct proportion to the units you consume. Whereas fixed cost is a cost which is not influenced by changes in units. So it's so the quantity does not have an impact on your fixed cost in the short run, whereas variable costs are changed with the quantity. In this example, for example, a fixed cost in our day-to-day life could be your rent payment. So it's fixed for a month. It doesn't matter whether you stay in that unit for 1 night or 10 nights, you pay a monthly rent. And same thing, say your car lease payments, whether within a allocated mileage or kilometers, your cost will be fixed for that month. Whenever you are thinking about a business plan, one important point is this break-even point, the operating level at which you generate zero income. Why is this break-even point important?
It kind of gives you an idea about number of units that you'll need to sell to kind of achieve for your revenues to kind of offset your costs. So it's a simple metric to track and understand the validity of the business model.
Thank you, Abdul. Very good. So that's at least the minimum you want to achieve, right? So you want to at least break even, and that's the point where you are going to cover all your costs. So your revenues are just enough to cover all your costs. So that's an important milestone in your project. So like if you don't meet that break-even point, you're going to have losses. So at the least, you want to break even. That's one important milestone you are interested in. And of course, just breaking even is not good enough. You want profits because you want your return on investment, both your capital investment and for all your sweat investment. You want profits, but the starting point, of course, is the break-even point. So that's an important milestone. So let's go through some examples on how to calculate this break-even point. And the break-even analysis is that which examines the relationship between a firm's cost structure, a relative proportion of fixed and variable cost, and the sales volume, and the effects of this relationship on profitability. So, and again, I'll try to explain these with a couple of examples in the next 2-3 slides. So let's come up with this example, a break-even point example. So so this is in the pandemic, we are interested in face masks, and you have this you are a great designer, you're going to design some face masks and going to sell. And what you do is you think you have a unique design which will have a market. You have done your market study, and you think you can sell your mask for $10 a piece. And you're not interested in producing them, so you have a supplier who would provide you with this mask for $5. So for every unit you sell, you are going to gain $10, but then you have to pay to a supplier $5. So you will have a net cash flow, which we will define as contribution per unit, $5. So every unit you are producing, you're selling, you're making $5. And of course, you have a fixed cost of $1,000 because you are getting the word out about your fantastic mask on social media, and that cost you $1,000. So that's the business idea you have. And let's see how many units you need to sell to break even here. So if you sell 0 units, so you sell nothing, what would be your profit?
0.
Thank you. So the one answer is 0. No, so you have already set up your business where you have a supplier at $5. You are advertising. You have incurred the advertising cost of $1,000, but you ended up selling nothing. So what would be your profit now?
Minus 1,000.
We'll be at a loss, yeah. Minus 1,000.
Minus 1,000, right? So because you have 0 income, but you have a fixed cost of $1,000. So your profit is, you have a loss of $1,000. So that is what you would incur because you are saddled with that fixed cost. You have no revenues, but you don't have to pay anything to your supplier because you didn't sell anything, you didn't buy anything. So you have $1,000 loss. If you produce just 1 unit, how much will be your loss now or profit now? You just sell 1 unit. What would be your profit or loss now?
So minus 995.
Thank you. That's good because you are only generating $5 cash flow for that 1 unit you sold, but you're still saddled with $1,000 of fixed cost. So you have $5 you're generating minus $1,000 of fixed costs. So that will give you minus 995 loss. Agreed? So that's what you would have. So for every unit you are selling, you're generating a $5 cash flow. So how many units you need to sell to break even?
Is it 200?
It is 200, right? Because you have to generate that $1,000 of cash flow, and each unit gives you $5. Because that's the fixed cost you are saddled with. Each unit you sell gives you, so that will be 200 units, right? So you need 200 units to break even. In another way of looking at it, if you sell 200 units, you are going to make a cash flow of $1,000, but that $1,000 will be wiped out by your $1,000 of fixed cost. So you will end up with $0 of profit, right? So you need your baseline. If you don't sell 200 units, your idea won't work. At the minimum, you need to sell 200 units. So if you're whatever the market research you did, you Instagram all your friends and ask them how many are willing to buy this fantastic design you have. And if you are not getting love for your product and you don't think there will be 200 people are willing to buy or 200 units of sale, then it's a no-go from the beginning, right? Like that's what you would do. So if you and then once you know the structure, then you can easily say, okay, if you if you sell 500 units, because you're just buying and selling, it's a trading operation. If you sell 500 units, what would be your profit? Okay, like now you can do your income statement on the back of your envelope, right? So with 500 units, what would be your profit?
Will it be 1,500?
1,500.
Yeah, it will be 1,500, right? Because for each unit, you're going to generate a net cash flow of $5, out of which you have to pay the $1,000 of fixed cost for your marketing. And so you will end up with $1,500, $1,500 of profits. So now you can easily, like on the back of your envelope, you can start calculating your profit. So if you then say do 2,000 units, it's simple, right? Again, if you do 2,000 units, then you know it will be 10,000 cash flow you will generate, and your profits would be $9,000. So you will generate a profit of $9,000. So once you understand a simple concept like this, you understand your financial statements. You know, you can prepare a simple projected financial statement with simply knowing what would be your selling price, what are your total variable costs per unit, and what would be your fixed cost for any activity level you are projecting. You could simply write down a financial statement. Questions?
I think that makes sense. So essentially, when the quantity is zero, there is no variable cost. It's only the fixed cost that we are essentially dealing with. And then as we start producing, then we start adding the variable costs and so forth.
True. So it's because you are buying and selling. So if you don't have any sales, you are not buying.
Okay.
So that's why the variable costs are only relevant, like comes into play with the amount of quantity you are buying and selling. If you don't sell anything, you're not buying anything. So yeah.
Perfect. Thank you. So much.
Like as I said, like, you know, if you're not hungry, you're not eating, so you don't have a cost of buying a burger. Right, so it's only when you are selling, you're buying. So of course you will have in like some stocks you might carry, and then the carrying cost. But in a very simplified idea is that variable cost you incur only if there is some sales. There is some sales, you are incurring that corresponding variable cost. Thank you so much for your answers. So let's move on to my next slide, where we are going to manufacture and trade customizable face mask. In the first example, we were just buying and selling. Now we are going to manufacture, like say in our basement or in our garage, and then sell it to our friends. So since we are manufacturing, our variable cost would be simply the material and packaging and that. Like so our variable costs are much lower because we are transforming material into and transforming our material into a face mask and printing them and customizing so that it looks great. And so we are not buying from outside, so we are not giving some profit to others, so we are keeping all that profit to ourselves. So our variable cost in this instance is going to be just $2. That's just the material cost, and we are still going to sell at $10. So for every unit we produce and sell, we are going to generate a cash flow of $8. But now our fixed cost is going to be high because we have a digital marketing cost plus cost of leasing some sewing machines and salary and rent. We need to pay somebody for the basement or garage we are renting. So our fixed costs are going to be much higher than we were simply trading. So once we have now in this cost structure where the price is $10, but our variable cost of $2 and we are generating a cash flow of $8 for every unit we produce and sell, but we are now saddled with $4,000 of fixed cost. So if you don't produce and sell anything, if your quantity is zero, what would be our profit?
Is it zero? Oh, sorry, it's minus 4,000.
It's minus 4,000, right? Because we are again saddled with now a larger fixed cost. So earlier we had a smaller fixed cost. Now that we have manufacturing in-house, it is going to be minus 4,000. And so every unit we produce and sell will give us the cash flow of $8. So if you only produce and sell one unit, we will generate only $8 of cash, but we'll have a fixed cost of $4,000. So we'll be saddled with a large loss again of 3,992. So you have you'll just generate $8 for that particular sale, because you just have 10 minus, that's the selling price, minus the variable cost of $8, and but you're still saddled with your 4,000 fixed cost, so you will end up with minus 3,992. So much larger loss than earlier, because you are now taking higher risk, right? Because you think you can manufacture and sell and get a higher profit margin, but in the process you are also taking a larger risk. And what would be the break-even point now?
The break-even, I'd say, is 500 units.
Yes, because you have this fixed cost. Thank you. So you had this fixed cost of 4,000 units, but you generate $8 per unit, which will be 500 units. So another way of looking at that is with 500 units, you're going to generate $8 per unit of cash flow. So 500 units, $8 per unit of cash flow. That's 4,000, and then you have the fixed cost to cover. So we will have a zero profit. Remember, in the first example, when we made 500 units, we were making a profit. Remember, like we were making, I think, $1,500 of profit. So it takes much larger number of units to make a profit here, because you have higher fixed cost. But if you think about, if the quantity is now, if the quantity is now 2,000 units, what would be the profit? What would be the profit if you have 2,000 units? Now, for every unit, you're going to make $8 of cash flow. That's 1,600 minus 4,000 fixed cost. Now we are going to make 12,000 profit, which is much higher than what we would have made earlier. I think earlier we made, in example one, just 9,000 profits, because once you break even, your profit potential increases, right? Because for every additional unit, you're going to make $8 of cash flow, whereas earlier in example one, you only made $5 of cash flow. Because you are sharing your profits with your supplier as well. Here we are keeping all the profits in-house. So the idea here is when can you, which kind of risk are you going to take? So we'll go to that next and to talk about what kind of. But before doing that, even like with this simple example, we know we can write an income statement, like formally, we can write the income statements. For 2,000 units, we are going to have this amount of revenues, which is $20,000 of revenues. Your total variable cost like your material cost in-house, which is $2, which is $4,000. So in effect, you're going to make a cash flow of $16,000, of which you are down with the $4,000 fixed cost. So you will end up with a $12,000 income. So now you can make a budgeted income statement on the back of an envelope very easily. So for any idea you have, if you know your fixed cost, if you know your variable cost, and if you whatever the market research tells you, what is your activity level, how much units or service you can provide, the quantity of service or products you can sell, you can immediately come up with a budgeted income statement. There's a simple framework to come up with a budgeted income statement. And that would be a nice way of communicating the potential of your idea in a business plan. Questions?
I have a question. How would you know when to go out of business? Like, I know the slides that you had before is just before production or just entering into business, but what say if you've been in business for a while and you've been making a loss, would you go out of business right there and then, or would you carry on production until like a certain time?
Yeah, so that's a very good question. So then, as I said, like, so you are making a loss due to two reasons, right? One, you're not achieving revenues to the potential you thought, or you're saddled with a cost structure which is driving the losses. So first thing you would look at is it because of the market potential, like your revenue potential is limited? In that case, it's difficult to restructure. But if you think it is the cost structure which is bringing you down, so instead of producing, maybe you might say, okay, now maybe I need to outsource because the production is not being efficient. So, or I'm saddled with all these fixed costs, which is bringing this my business down. So if there are opportunities to restructure your cost, because you still are convinced that there is a market for your product, then that would be your business is still salvageable. So did I answer your question, Ranki?
Yes, because then it was more structured around, like, you know, if you had you have your fixed cost, let's say you're paying mortgage or rent for a year, and you're straddled with that fixed cost, but it would be more favorable to stay in business and operate at a loss than to just shut down the business, because then you'd be straddled with probably a greater loss because of the fixed cost that you have, right?
Very true. So like a simple rule of thumb is, if you can't even cover your variable costs, you cannot be in business. So you need to, your price you need to charge has to be greater than variable cost. Otherwise, you have a net contribution margin or net negative cash flow. So any additional sale you're making, you're digging deeper your grave. So the first rule of thumb is you need to at least cover your variable cost. And to do that, you need to actually know what your variable costs are. So once you know all your variable costs, you need to sell your product or service at a price much higher than your variable cost. So then you have a positive cash flow. Then, so even if you're saddled then with a higher fixed cost, you are generating some positive cash flow to set off some of your commitments which you can't get out in the short run. But then in the long run, you may need to restructure your business to say, these fixed costs are drowning me, so I need to have a different business structure.
Thank you.
Thanks. Thank you. That was a very good question. Thank you, Ranki. So coming to the next slide. So, all like in your budgeted income statement is categorize all cost into fixed and variable cost, estimate the sales price, what would the market, how much you can command in the market, and then estimate the demand in the market. And then we can easily find your budgeted income or projected income using a simple idea, right? So what's your total cash flow minus fixed cost would be your budgeted or forecasted income. This holds within a given installed capacity. So you have you have leased out some machines and space, and now you know you can produce 2,000 units of face mask. Maybe you can produce up to 20,000 units of face mask for a given period of time, but doesn't mean you can produce 200,000, right? For a given installed capacity within that, this cost structure would work. So when you are other main considerations, when you're thinking about a business plan and cost structure, like in the example one, you said, like, let's buy from an outside supplier. From example two, we said produce it in-house. So when will example one type of scenario make sense? If your demand is uncertain, then example one makes sense. Yes, it's less risky because you are saddled with less fixed cost. So your risk is less, but your profit potential is also less because you are sharing that your supplier, right? Some of the profits you're going to make, you're going to share it with the supplier. Whereas when you're sure of your demand and you're not, and then if you're projecting large demand, then it might be worth producing it in-house because you have a lot more control on the supply, on the quality, and you are confident, you have the confidence to incur some additional fixed costs because you know there is a market. So if you think your demand is robust, then maybe producing it in-house makes sense because that gives you higher profitability. Of course, it's a higher risk. It takes more units to break even, and you have a larger fixed cost. But if the demand is certain, then your profitability is going to be higher. Another considerations, a business consideration you might need to make with the numbers we have looked at is, can you accept a special order? Okay, well, another friend of yours is coming to you and saying, okay, I love what you're doing, but I have another idea, a new design. Can you do it for me? Because you already have your manufacturing in place and you seem to be producing high quality masks. Would you do it? So right now our cost structure is, say, we are selling at the structure we have, financial structure is we are selling at $10. Our variable cost is $2. Fixed cost is $4,000. And we are operating at 10,000 units. Every month we are selling 10,000 units, and we are making quite a lot of profits with this. But we can go up to 20,000 units with whatever the machinery we have. So if that's the case, will you accept a special order 5,000 units at 5 per unit? How will you think about it? So if your friend comes and says, can you give me this certain, the different copyrighted design I have, can you supply me 5,000 units at $5? One thing you could say is, nope, I can sell it at 10. I'm not entertaining your $5 offer. That's one way of looking at it. But my own product is maxed, demand is maxed at 10,000 units. I can't sell anything more. So will you take this, accept this special order? Yes or no? Any knee-jerk reaction to that question?
I'm tempted to say yes, because it has a positive contribution margin.
Very good. I think that's the way I want you to think, because will you accept? Like, yep, because it's for every unit you produce and sell, you're going to make $3 of contribution margin, right? $3 of additional cash flow. Agree? So, so if you accept this 10,000 unit, like another 5,000 units, how much will your profit go up? If you accept this special order from your friend, what would be the net effect not in your bottom line? For every unit, you're going to make $3. So for 5,000 units,
15,000.
15,000 units. So it's a cool 15,000 you can pocket from whatever the current existing profits you are making. You will make an additional 15,000 if you accept this special order. So you will not think in the way where, no, I sell it at $10. Why would I now sell it to my friend at $5? No, you still have excess capacity. That capacity, like your variable cost is much lower than 5. So by accepting this special order, you could still increase your profits, right? So that's another consideration you might have, or you might even build this kind of considerations in your business plan. What is the probably some so the reason to accept, of course, is you are having these additional profits, which is a good reason to accept this special order. Maybe another good reason is you want to help out your friend as well, right? So establish another market. So what are the disadvantages or any cons with this accepting this special order?
Maybe your other customers might see this and request lower prices, might damage your brand.
Very true. So one, of course, your friend's mask might directly compete with your mask, and your demand, although you're projecting 10,000 units, your friend might come and steal some of your customers, right? And if the friend tells you're selling to your friends in the same circle for $10, but this is a larger quantity, you are selling at $5. Yes, but so if you are doing business in Toronto and your friend is in Windsor, not a problem. But if your friend is in Markham or Mississauga, then it might be a problem because then you don't have the separation, right? You're selling at a lower price. And if the friend then goes and sells at $8, that might impact your sales. Other thing, of course, is you don't want to work now your capacity is 20,000, you are doing 10,000 sales, and another 5,000 that might create some capacity constraints, quality issues, so like in your operations as well. So it is like you might have some other things you may need to consider, but overall it seems like a good proposition. And once you have this, you can then talk about a projected cash flows. So you will start with some cash in hand, and then you'll collect cash from your sales. That will be your total cash available. And then you need to supply to your payments to your suppliers, your salary, rent, lease payments, other payments. That would be your disbursements. And if you are a profitable business, you will have a positive cash flow. A minus B would be a positive cash flow. But if it is, when you're starting up, you have some startup cost, you might have a negative cash flow too. So then you will think about lining up external financing upfront. And you might also want to have a cash buffer. So depending on how much cash buffer you need, what are your startup costs, you might need some external financing. So you can start planning for your external financing right upfront by having a cash budget. So now you have a idea about projected income statements, projected cash flow statements. These will be important financial models in your business plan. When you're talking to potential investors or friends who want to invest or banks which want to lend you money, you might need these statements. Financing needs, of course, you will have some startup costs, like maybe you want them to be, as I said, your fixed cost, you want to be as low as possible to reduce your risk, but you will have some product development, regulatory approvals, market research, legal costs, and you may need to carry some inventory and some operational costs like you build up in your cash budget. So you need to think about what is, you have a great idea, it's a profitable idea, it can easily break even at a normal operating level, it's going to generate healthy profits from your projected financial statements. But then you need to know what is the initial investment you need. So you need to count, you need to think about all these different line items. And then go and look for financing, right? From grants or investors, bank loans, or crowdsourcing, right? Like all these, you can say you have this great idea. Do you want to be initial partners? And you go to crowdfunding platforms and ask for money. So you have so many different ways of sourcing the financing for your idea.
I can share a little bit from my end. So I recently started with a VC firm. So Giri, when you spoke about alternative sources of funding, crowdfunding and VC, it's very prevalent. Even and to Ranike's point, sometimes you need some capital upfront to kind of help you reach break even and reach the quantities where the economics kind of make sense. So I think this is very prevalent discussion.
Thank you, Abdel. I agree. And thank you for bringing your point of view.
And Giri, I have a question for an entrepreneur that's working on their business plan and looking to kind of tailor it for example, banks and other sources of funding. How would you advise them in terms of finding ways to kind of control some of those fixed or variable costs? So you spoke about bringing things in-house versus outsourcing. Any advice you would have for entrepreneurs in terms of how to tackle the cost side of things?
I think like even like very successful businesses would focus a lot on the cost side. So the more flexibility you build on the cost side, where that means like, you are thinking about outsourcing and reducing your fixed cost is the way to go. So then you are reducing your risk. But once you are established, then it's a different story, because then you have a market, like your products or ideas have been tested by market, then you can take a higher amount of risk. But initially, the cautious approach would be until you test your market, don't saddle with too much risk.
Yeah, that makes sense. Stay as lean as long as you can.
So thank you, everyone. That was very interesting, and thanks to your contributions, I was able to have a conversation. Thank you so much.
Thank you, Gary, for an insightful presentation. You definitely made those numbers dance on the screen. And also thanks to all the students and the questions that were shared this evening.